More and more South Africans are relying on personal and payday loans to survive the rising cost of living. Debt-to-income ratios for top earners are also at record highs, despite growing consumer confidence. And 91% of debt counselling applicants hold personal loans. That's according to DebtBusters Q1 2025 Debt Index. And joining me now to discuss these worrying trends is Bennai Sager, Executive Head of DebtBusters. Good afternoon. Well, your data shows that around 76% of personal income goes to debt repayments for both low and high income earners. This is a staggering number. How are consumers still managing to get loans when they're already so indebted?
It is a staggering number, and I'm glad you pointed it out because it's a very important number. It means more or less 8 out of 10 rands would need to be spent on debt repayments. It is a question we also wonder. I think why it ends up in this situation is because often, there's somewhat of an underrepresentation from consumer base as well as to the real income. The real challenge is that because incomes haven't grown, consumers are feeling the need to supplement them with additional sources of income. And the first port of call, it seems to be going for loans, particularly personal loans. As you say, it should never come to this stage, particularly for younger people. We really want to catch them early on and give them the right advice. But it really is for us at the highest level since 2017, and we haven't seen numbers like this in almost 10 years.
Mm. Now, what responsibility do banks and loan businesses have in making sure they don't grant loans when a customer is already so heavily indebted?
Yeah, I think one of the things that we're hoping that will change soon is there's something called the minimum expense guidelines when loans are granted. And lenders can use this as based on your income bracket to determine what should be your spend on minimum income, minimum expenses. The challenge is this is in place since 2015, but the amounts have not been updated since 2015. Now, if you think about the impact of inflation and interest rates and everything else since that period, the numbers are way out of sort of where they need to be. And I think this is part of the reason why people are able to sort of borrow money that they really should be, because the minimum expense guidelines that's guiding the lenders are basically, they need to be updated. They're 10 years out of date.
It's actually quite shocking. That's incredibly worrying and incredibly shocking to hear that 10 years out of date. Well, I understand that debt counselling completions have increased 11-fold since 2016. What's being done, though, to prevent consumers getting into this situation in the first place? I mean, you mentioned that 10-year-old data. I mean, surely we need to get that up to date to stop this from becoming more of a problem.
Yeah, I think consumers, first, we are very proud that more and more people are successfully completing the program. The thing about debt counselling to always remember is it's in the National Credit Act for good reason for people to use when they are struggling with debt repayments.
Yeah.
So it's actually the responsible consumers choosing to go this route to honor repaying back their debt. At the same time, as a country, we should be worried about a few things. One is because of the lack of growth economically, I think the pool of available applicants who will actually qualify for loans has actually shrunk. In fact, if you look at the National Credit Regulator's data that shows what % of loan applications has been accepted versus declined,
yes.
A few years ago, about 45 to 50% of the applications were accepted. Now it's down to 33%.
Right.
And the application volumes are much higher than they were a few years ago. So that actually tells us across the income bands, across the consumer base, there's severe need to or desire to borrow money. We also want to urge consumers to really say, okay, do I really want to spend money, or do I really need to spend money on something? Times are tough and people are doing their best to stretch their money. But really rethink about whether things are essential for you to spend money on, and try to use as much as possible pooling of resources, signing up for rewards programs, and just stretch that money that you've got so that you don't have to borrow for consumption purposes. I think borrowing for homes and so on, perfectly fine. We all need to do that in any case, or starting businesses. It's the borrowing for consumption that I think we really need to, as a country, deal with.
Indeed. When we talk about debt in this country, personal debt, and we're speaking about, their income hasn't gone up that much over the past few years, so they're borrowing more so they can maintain their standard of living. What other things are taking up their money? What else are people spending their money on? It can't just be their cost of living.
No, it isn't. So one of the interesting things has been across the income bands, we looked at what people are spending the money on with regards to the budget that remains after debt repayments. And we saw that across the board, about 25% of what remains is being spent on electricity, water rates, and transport. And all of these four things, I would argue, they're all regulated, and in the end, petrol price really and the electricity price are one of the drivers of that. And what's happened is the rates of all of those four things over the last several years have gone up significantly more than the CPI. And it's really eaten away the money that people really have. And this is one important driver. The second one is that after COVID, particularly high-income earners have come under a lot of pressure to provide for a wider range of family members. We've certainly seen that in terms of the number of people they're supporting. And they also happen to be, in most cases, the only breadwinners and the only ones eligible to borrow money. So they're also borrowing on behalf of supporting other family members because the times are tough. I think those two things have really driven consumers to the situation that we are now.
Well, we'll leave it there for now. That was Bennai Sager, Executive Head of DebtBusters.